Hello and welcome back to The Note. Let's talk about Japan today. It's been the latest victim of market volatility this week. Could there be an interesting value proposition there? Now, what fascinates me, it's always a country of great contrasts, is the disjunction we saw in the headlines back on Tuesday. One headline was that the Japanese stock market had fallen more than 4%. This was largely, it said, due to bad data in the US. The next headline on many services was about Toyota reconfirming itself as the world's largest seller of cars, beating forecasts, making a more optimistic forecast for the future for sales and profits, and its shares falling more than 5%. Now, something strange is going on there, and that is, as we can illustrate for you now, because the Japanese stock market continues to be treated by all and sundry as though it was one big currency play, one big play on the yen. A weak yen is held to be good for Japanese stocks and vice versa. It's as though the entire country was one large exporter which did nothing else. Consequently, the main Japanese stock indices end up looking very much, after you've adjusted for the currency, like the US S&P. Now, that obviously suggests that you should not be going overboard into investing in Japan in a big way while we still have so much turbulence playing itself through in the foreign exchange market. But as you can see, this looks like an overreaction compared to what we've seen in the yen from Japanese stocks this week. And that does suggest that there could be a value opportunity emerging, because there is very intriguing evidence that Abenomics, which has been around since late 2012, the new Premier Shinzo Abe's big aggressive attempt to jolt the country out of deflation, is beginning to work. If you want one exhibit for that, you can see that inflation expectations are actually now higher than growth expectations in Japan. That's a very intriguing development. There's also a raft of indicators suggesting that spare slack in the economy is being picked up. For example, we're seeing very significantly higher machinery orders. You could also point to higher attempts to populate real estate. Now, on top of that, perhaps the single most important thing for investors in equities, as always, should be earnings. And there's very emphatic evidence that Abenomics is converting into higher earnings. What we're showing you here is 12-month trailing earnings for the topics compared to the US S&P 500 companies and the FTSE Euro First 300 companies in Europe. And you can see that earnings growth in Japan has utterly dwarfed the rest of the world since Abe came to power. That's even in constant currencies without taking account of the change in the yen. That's plainly very significant. Further, Japan, unlike any other significant region in the world, actually has positive earnings momentum. This is a series that's kept by Andrew Lapthorne at Societe Generale, and what we're looking at is the proportion of changes in forecasts for earnings in different countries that are positive. In the case of Japan, it's the only country where positive upgrades are outnumbering downgrades, and in some key sectors such as more or less all the financials and some of the big exporting sectors such as electronics and cars, earnings momentum is overwhelmingly positive. Forecasts are being marked up. That suggests that once the turbulence is over, there really should be some kind of a value opportunity in Japan. Where exactly can you find it? Well, if you're not too bearish about the economic prospects for the emerging world, plainly there has to be something very interesting going on in those key exporters. Many of them had worked out how to be profitable at an exchange rate of 80 yen to the dollar. Providing the yen stabilizes at 100 or more, they should be able to continue to be very profitable indeed on that basis. You could also make a case for real estate, which has been one of the sectors that has been most aggressively sold off so far this year. But perhaps the most interesting area to look at might be the banks. If you want a serious value opportunity, you will usually find that in sectors which are really seriously out of favour. And it's hard to think of any sector in the entire financial world that is more thoroughly out of favour than Japanese banks. We've been used to talking about them as zombies for some 2 decades now. But if you look at the facts at the moment, first of all, valuation, given this latest sell-off, is still unchallenging. Many of them are trading for less than book value, and they're really, after the latest fall, no more expensive than they were when Abe got in. Further, loans are expanding. That's also leading so far to compression of margins, but you do see loan growth, increasing demand for credit in Japan. Therefore, providing we can avoid the more alarming scenarios for the world economy, which is still not a given, we could ultimately discover that the story from this incident is not so much the meltdown of the emerging markets as the return of the zombies.